Afternoon, everyone. Thank you for joining us this afternoon. Um, tonight, today, we're here to talk a little bit about our investment options for fund holders here at the Community Foundation. And we'll talk a little bit about what those are all about, what they might contain, and risks and rewards associated with them. We'll talk a little bit also about the recent market volatility and some of the things that everyone uses to try to circumvent the effects of those. So without too much more, I think we'll go over an overview of what the pools that we have are. There are three of them. That's the short-term pool, the long-term pool, and the ESG or environmental, social, and corporate governance pool here. And then we'll talk a little bit about market volatility. At the outset, you can see that, or you will see that these pools offer different investment strategies, which can dictate a risk and return expectation for your fund, and they have different purposes. Two of the pools are long-term in nature. They have investment horizons that exceed 5 years, with a even longer investment time horizon, which is like 20 years in the long-term pool. The short-term pool is largely reserved for time horizons that are less than 5 years and or where inordinate market risk would invalidate the purpose of the fund. So those are the overviews real quick. And let's move into the short-term pool. First one, the short-term pool, again, as I said, it's less than 5 years. Funds electing this pool are housed in basically a money market environment that protects largely against market risk, but it's not expected to produce what we would term acceptable long-term returns that would meet endowment goals, but rather be more of a safe haven type of situation for the short-term oriented funding that expects to grant out a major portion of its assets in less than 5 years, typically non-endowed funds. Uh, so that's a very basic one, and we don't need to spend a lot of time on that one, but now we'll go into the long-term pool. And in the long-term pool, uh, you can see that our board of directors believes in that we should be here for the long term. We want to emphasize that long-term growth that's appropriate for an endowment. And we want to avoid some excessive risk in that portfolio. It's a fairly conservative portfolio. It's diversified across a variety of different asset classes. And that we're attempting to preserve the purchasing power of the initial donations or donations over time by inflation proofing those dollar figures. So $10,000 put into a fund today is not worth $10,000 100 years from now. It's worth something different than that. So we're trying to make that $10,000 grow along with investment returns. Uh, that long-term pool and this investment policy statement is a document that exists on our website. That document houses and empowers and both or restricts our committee within certain asset classes and risk tolerance to create or to define the specific investments within the various asset classes and their respective targets. That long-term pool has existed at ACF since 1995. It's the one pool that we've offered up until June of 2022 for long-term and oriented funds when we added the ESG pool option. Uh, it's the main pool that we have with the largest batch of assets between the three funds that we have, or three pools, sorry. Uh, it has around 190 million or so in its portfolio. To give you a comparison, our short-term pool has about 18 million and the ESG pool has about 5.5. So it's by far, this long-term pool is by far our largest and it's the most diversified. It consists of about 53.5% global equities. Those are stocks. They include both public and private equity, and sometimes some hedge funds that are specific to equities. We have global fixed income as well. That's about 25% of our portfolio. Fixed income consists of bonds and interest rate and credit instruments of some kind, federal securities, so on, treasury securities. Uh, we have real assets at about 9% of our fund. Those are things you can touch, things you can put your fingers on. Everything from real estate, natural resources, infrastructure, things like that. Uh, Diversifying strategies, hedge funds, and investments, private equity, private debt that are generally expected to work in a fashion that's not in direct association with the public markets, the stock market and the bond market. They're supposed to work in a non-correlative manner. And then we have about 2.5% in cash to allow us to have the necessary liquidity to meet the demands of our funds without having to sell in a fire sale manner any assets that we have. That long-term pool's focus is growth, as we said. It's the main strategy and vehicle of the investment policy statement. And it's the focus generally of our investment committee, although not entirely. Um, its returns are listed here as of 12/31/24. You can see the 1 year, 3 year, and 5 year uh, uh, return percentages, and a comparison to two benchmarks that we measure ourselves by. We've been modifying that second investment objective. And so you won't see that on the March one because we're still in the process of redoing it. But as of the 3/31, we had lost about 0.69% in our portfolio. Uh, and you can see that that changed the 1 year, 3 year, and 5 year averages um, because of what was going on in that quarter and because it's now looking back March to March as opposed to annual kind of number. So, but the returns are there. The balanced index consists of basically a 60/40 type environment, 60% global equities, 30% the Bloomberg aggregate index, and a 10% Bloomberg tips index as well. Uh, that's what that balanced index one consists of. The investment objective that we've been modifying uh, relates really to our underlying investments and the asset allocation that's contained in our investment policy statement and what our portfolio managers would be expected to perform against. And so it's somewhat more tailored and much more complex to describe, but you can see the returns there. And the third one uh, for our investment pools is the environmental, social, and governance pool. Uh, what is that? Well, that is a pool that has specific criteria. It's called investing with a purpose, as opposed to just meeting and finding investments that are strictly associated with return. These investments are tailored to meet a certain set of criteria and whether or not they will be potentially included or excluded from the portfolio of investments in that pool. Uh, it uses some screens, both positive and negative screens, to sense environmental. How does a company perform as a steward of nature? Social, how it performs managing employees, suppliers, customers, communities, and its governance, how is its transparency in terms of audits, in terms of executive pay, shareholder rights, and things like that. So a positive screen would be one where we decide that we are going to include it. A negative one would be excluded. You can see from some of these, it uses two different screening tools, as I described. A positive one, it scores those three ESG factors and decides whether or not that entity qualifies to be invested in. A negative screen specifically excludes an entity if it's involved in things like civilian firearms, controversial weapons, oil sands, tobacco, things like that. Uh, the comparison between the long-term pool on the left, you might remember what those uh, asset allocation uh, classes were. You can see that there were four of them plus cash. And the ESG pool is really a 60-40 split, and that's it. It's less diversified. It is diversified slightly differently, however, because it consists of a variety of exchange traded funds and the underlying holdings within each of those. And that's what this graphic shows. This graphic shows that the ESG pool consists of a ticker symbol. It's EAOR or EOR, as I like to call it. EOR uh, consists of a variety of other underlying ETFs as well, and those ticker symbols are listed here. Uh, and you can see that how it's split up, but large caps, middle US versus Europe, and we'll call them the developed countries outside of the US, emerging market stocks. It also has a small amount of small cap stocks in it, and then bonds at roughly 40%. And you can see the underlying number of holdings that each of those has. So it is diversified that way, just not in the same manner as our other portfolio. To sum up that particular option, it's a simple way to invest in a diversified, somewhat diversified, sustainable portfolio. But the lens is always this investing with a purpose, and it's less return driven than it is that purpose driven type of information and inclusion or exclusion from the actual pool in terms of an underlying investment. Those screens, if you're interested, you can go on and read the definition of those. EOR is a BlackRock uh, provided exchange traded fund. And if you click on that item, you'll go to their website to go see their underlying information. You can read the prospectus, and it's delightful reading if you need some sleep at night. But so take a look at that. To sum that up, the ESG pool, it's a diversified, sustainable portfolio. Again, investing with a purpose. Uh, its returns look like this for the 12-24 time frame. Uh, and you can see had a negative quarter in the fourth quarter, which it was expected. Uh, the 10-year returns, they're pretty close to the 60-40 index that we're using to judge it by. Um, and since we only offered that from July of 2022 onward, you can see the inception returns there. And then you can see what happened in Q1 of this year. It took a little more of a hit from its portfolio than our diversified one did, but uh, you can see that it's still performing reasonably well as well. Um, so it will differ than our long-term portfolio, but that's okay. But recognize that it's just going to be different. Sometimes that will be better. Sometimes it'll be worse, depending on what that 60-40 sort of diversification element does to you. Um, More information. As I described earlier, the long-term pool is governed by the investment policy statement. That's available on our website if you want to take a read. The ESG pool, later on, when you get a copy of these slides, you can click on that link that was provided there and you can see it, or you can Google ticker symbol EAOR and you'll get the start of all of that information as well. And then our short-term pool, again, is really short-term in nature and focused on an investment with, I'll call it minimal risk and probably associated minimal returns. The money market environment's fine right now. The investment or interest rates are generally governed by the Fed, and those interest rates are at this point around 4.25% or so that we're earning in that fund, which is fine. Uh, but I wouldn't expect that to continue. If interest rates rise, that would certainly be beneficial to that fund. If they go down, then its returns will go down. But again, it's more about protection of the principal as opposed to being there for the long term. I can stop there for a moment and ask if there are any questions. There's some more to go with respect to diversification and some of the elements that we might talk about long term. But are there any questions that have popped up in the chat or?
There's no questions in the chat, Kevin, but yeah, this would be a great opportunity if you'd like to go ahead and unmute yourself and ask a question. If not, we can move on, but we'll wait for a few minutes or a few seconds. Okay. Hearing none
Okay.
and no raised hands, I think you're good to move on, Kevin.
Okay. All right. So let's talk a little bit about investing during times of trouble. We certainly experienced that in the first part of April. The markets decided to react to some macro environmental things going on, both in Washington, D.C. and elsewhere. And you can see, or probably have seen from either your 401k or the headlines, things that have been happening there. Um, I'll briefly flip up one of the same slides from before. Uh, with three of those elements highlighted here: perpetuity, long-term, and avoid excessive risk. Remember that what we're talking about is the long-term pool here, which is a fairly diversified pool. It's fairly conservative, so we're there but with a long-term investing horizon. Uh, so let's talk a little bit though about just US based stock market, the S&P 500. So the S&P 500 is an index of funds that consists of 500 funds that the Standard and Poor's or S&P group decides on in terms of its market cap to be included or not. And from 1926 to 2024, the end of 2024, it returned an annual return of about 10.2%. Uh, so here's the trivia question. That's the average over that same period, 1926 to 2024. How often did that actually fall in a window between 8 and 12%? So 2% below that average or 2% above it? And I won't make you all guess, but here's the answer. Out of those 98 years, only 8 of those years did it fall within that window, which means that it's varying all over the place. Okay. And I will show you that in graphic terms now. You can see that the green bars are positive and the red ones are negative. Uh, and you can see that it's kind of all over the map, isn't it? So averages are fine, but they aren't the necessary, they're not what you see or experience in the markets for a year. Uh, and the other thing I think you can notice from this, and I'll show you a slide here in a moment, but there are more green bars than there are red ones on this graph, aren't there? If you look at this stacked graph, which is another way of looking at the same information, you can see that over that same period, 73% of the time they were positive, 27% were negative. And you can also see just from the way they're stacked up um, that that generally the positive returns are somewhat larger. Not always, but somewhat. You look at the 10 to 20% bars. On the negative side over here, we have 14 of them. On the positive side, we have 23. If you look at 20 to 30% either positive or negative, we had 19 versus 3. So uh, not only do you have a preponderance of returns being positive over that long period of time, but you also have a fluctuation that tends to be much higher on the positive side than the negative. It's not to say that that will continue or that we should always expect that, but the time horizon is important. And when I say time horizon, we're talking about 97 years there. And that same time frame, you can see some very big things have happened over that time frame. And that graphic, the black graphic, is the actual S&P 500 going up and down. But notice the general trend of that is upwards, isn't it? The yellow bars are, and they're kind of obnoxious to read, frankly, but they are when we had a recession. And so you can see that those occur, but each of those recessions generally is followed by an upturn in the markets. Sometimes that takes a while for that to occur, and other times it bounces right back. But uh, that's always an interesting graph. I don't care for the yellow pieces on it because I think it just tracks from the other thing, but that's where I got it. So, but the positive annual returns, again, 73% of the time were positive. So what's that really tell us? Well, time is your friend, isn't it? The longer your time horizon, that the longer that graphic that goes up gradually across many, many years will be helpful. And that's again just the S&P 500, US-based stocks. That's all we've been talking about. Uh, it is volatile. You saw that all over the place with those green and red bars graphic. Uh, but there is a way to manage that, and that's called diversification. Um, and so let's talk a little bit about diversification. It's something called modern portfolio theory. Uh, you're basically trying to assemble a group of uh, uh, assets that are going to maximize your pool of returns that might be coming from those basket of assets, if you will. It's a formalization of diversification. Uh, and the idea is that owning different kinds of assets is less risky than owning only one type. And the old saying about don't put all your eggs in one basket comes, I think modern portfolio theory comes from that old saying. Don't put all your investments in Tesla, or you might see what would happen, or don't put them all in Coca-Cola, but do something different than that. Uh, and so you'll see that you have a better chance of weathering those things that are happening. It's built from complementary assets, typically things like stocks and bonds, that don't perform the same way necessarily. But it also can be a geographical one. It can be um, alternative instruments of some kind. It can be some of those things that we talked about in that diversified portfolio of ours, real estate, real assets of some kind, infrastructure, things you can stick your hand on, buildings, uh, pipelines, things like that. You've got diversifying strategies, which might include hedge funds or private equity and private debt. Again, trying to not be correlative with the market, trying to do something different. And why do you do that? Well, you're trying to improve your return and reduce your risk. And there are typically a couple of measures that we use to measure that. This is an example of risk. You can see the axis at the bottom down there. The x-axis is a risk, which consists of standard deviation percentages, and reward on the other side. Uh, this is for a different period than the one we were looking at earlier, 1978 to 2010. But the idea here is that the S&P 500 is this red line here, and uh, this is simply a split of 60/40 between the S&P 500 and long-term government bonds, right? That would be the return you would expect. and the amount of risk that you might get from that red line. If you simply take that red line, the same investment, but you add a component of real estate to it, guess what happens? That's a blue line. Not only does your risk move to the left, which is a better, less risk, but your return goes up. And the same with the green line. The green line is those two previous lines, but you now add in uh, small valuations that are outside of those. And so once again, you end up with a scenario where you're reducing your risk and still retaining the same return. And that's the whole principle of diversification. The principle of that is what we follow in our long-term pool. It's why we have these asset designations. It's why we have these uh, different categories of pools of assets. There are specific asset selections within that various category. Global equities has, oh, I don't remember, 15 or so. I can tell you that our global fixed income portfolio is about 74 pages long of a variety of different bonds. So there are lots of underlying specific investments within that class, but the key here is to make sure that you're having that portfolio diversified. And what becomes more important at that point is this asset allocation methodology that you're using and the percentages that are shown on the page than the specific investments themselves. And that's the whole theory of diversification in modern portfolios to construction. So, some of the same principles with diversification are present in that earlier discussion about the S&P 500. Time is still our friend. That longer time frame that we look at, the better or the more likely we are to have positive results. Equities are always still part of that and often are the preponderance of it. You see that from our portfolio here at 53.5%. And those asset classes are the important piece of diversification. Um, so basically, you have those three investment options for your fund here at ACF. You can select that once a year. We don't want funds moving in and out of these things trying to chase a return because frankly that almost never works because it's always in the past. And secondly, it's too much administrative burden when we have over 2,500 funds. Uh, but we do give you a window to switch that every year. It's a 60-day window. It starts June 1st. And there's some forms to fill out if you wish to elect it. When you create your fund initially, you elect a pool to be in. Um, but you can change that in this window if you prefer, or you can stick with it. Typically, as I said earlier, our long-term pool is the largest pool that we have and one selected by most of our funds. But when someone is interested in a very short-term environment, uh, 5 years or less, that short-term pool is probably more apropos. That way, you don't, if you have a negative 20% year in the markets, it won't take away 20% of your fund balance. And if that's important to you for giving it out next year, then that's the place to be. And then finally, the ESG pool is investing with a purpose and trying to do something slightly different for the world. And your return will be slightly different as well, but that is maybe okay. So that's all I really had. You can also go to this website, which you are also a part of already when you registered, but we put it up here on the screen. And I think Celeste may put that in the chat for you as well. If you'd like to grab that form off of there, you can do that, fill it out. It does need to be signed by an authorized person for your fund. That way we know that it's been vetted by your either agency or fund holder or fund holders plural. And that way we can make sure that you're in the right pool and we will put you in that at that time. That's all I have, but if you have any questions, I'm happy to try to answer them.
So, Kevin, there's a question in the chat. I'll read it out, and then Dawn, if you wanted to follow up, you're more than welcome to unmute yourself. But Dawn Kylie says, so ESG is a long-term pool. In other words, we can't move money in and out as often as the short-term pool.
Yeah, so the ESG pool is designed to be a long-term pool. It is designed to, it will have market fluctuations just as our other long-term pool does. Uh, and moving money in and out, you're not allowed to do except within that 60-day window of any of the three options that are on the screen. So, between June and July, end of July, you can say, okay, I elect to be in the short-term pool, but you got to hold that till next June. Or I elect to be in the long-term pool, and you at least have to hold that. I wouldn't recommend jumping back and forth necessarily because of that year window and because it really isn't probably going to increase the rate of return you get. I don't have a graphic in here, but I typically do when we talk about, let me look, I'm going to stop sharing for a moment. I might have it available. Um, uh, there's a graphic that talks a little bit about how if you miss a few days of the trading market when it jumps up again after an event like this April, for instance, if you're out for a week or so, you might miss about a 10% increase in your rate of return because you jumped out and didn't jump in at the right time. And so that market timing is virtually impossible unless you're a day trader and a very experienced one at that. Uh, and generally, portfolios aren't very successful trying to do that. As an example, actively managed funds typically in the equity markets don't outperform the general market about 91% of the time, about only 9% of them beat it. So, and that's because they're tinkering with things continually and not necessarily just accepting the market as it is. Uh, so I wouldn't recommend necessarily jumping in and out, but you do have the option of selecting one if you think that maybe the environmental things are going to be in place for a year.
Oh, and Don does have a file up. He said a follow up. He said, I didn't word my question well. Is our access to funds in the ESG more similar to the short term or long term pool? Long term, I think. Oh,
Uh,
and maybe this is just about pulling money out or granting it from the fund. Is how I'm understanding that.
uh,
Okay. Yeah.
Okay. Yeah. So, because we have such a large asset base, we're able to keep our liquidity external to your particular fund. So if you make a grant decision to grant some money out of your fund, we generally have the liquidity sitting around so we don't have to fire sale a bunch of assets. And if you have your money in that full pool, then you can uh, elect to take it out, and we won't necessarily have to sell your investment in that pool. It's because we have this macro pool that's made up of all of the people here at ACF are invested in one way or another in one of those three pools. Sharon is asking a question, it looks like. Um, Currently, we don't allow a fund to be split across the pools. Um, you have to choose just one or the other. Our software has that capability, but it does mean we might have to be moving money around more often. And as I just described, that's not necessarily a good thing to do for the overall pool. So, but right now, you currently have to have it all in one.
On your bond holdings, are they individual bonds or are they bond funds?
We have a mixture of both. The majority of it is specific bond holdings that's managed. That portfolio is actually managed by the Alaska Permanent Capital Management institutional people. Uh, but we also have a short-term bond fund that's more uh, oh, taking advantage of short-term duration items generally less than 1 year in both the treasury markets and elsewhere. But so we have a mixture of both, but for the preponderance is specific bond holdings. Any other questions? Did I go too fast? Anybody want to see the slide again?
There's no more questions in the chat.
Okay, well, I guess we can give you 24 more minutes back in your day then.
Like I said, we will be sending these slides out next week along with the recording. So if there are folks in your organization or other fund holders on your fund, they can get the same information. So you can wait for those to go out early next week.
Thank you.
If you have further questions, just let us know and we can try to answer those specific to your fund or specific to some other question that you might have. So just let us know.
Have a good evening, everybody.